What happens when 5 analysts, armed with fancy degrees and bloated egos, all manage to blow their calls on the same stock? You'd think with their resources, their fancy models, and their legions of followers, they could get at least something right. But somehow, they all managed to misread Bill Holdings stock spectacularly. And no, we're not talking about a slight dip in projections or an overly bullish price target. This was a train wreck, and it's the kind of disaster that should make any investor question how these people still have jobs. Now maybe you're wondering, how did so many experts miss the mark? What were they smoking to see a shining growth stock in a company that clearly had cracks in its foundation? Were they too caught up in the hype, or just outright lazy? This is a case study in incompetence, plain and simple. And today, we're tearing these analysts apart. But beyond the carnage, there's a valuable lesson buried here, a lesson about understanding what truly drives a company's value, not just parroting whatever Wall Street feeds you. We'll dive deep into Bill's stock, breaking down where the analysts went wrong, and more importantly, how you can avoid their mistakes in your own investing journey. Speaking of avoiding mistakes, one of the biggest mistakes you can make in this day and age is not getting into content creation, especially with how quickly AI is changing the game. If you've been on the fence, let me tell you, AI is the cutting-edge tool that will separate the successful from the forgotten. The few who master it now will be the envy of those still clinging to outdated methods. That's why you need to check out Matt Parr's Tube Magic course. It shows you exactly how to leverage AI to build a YouTube channel that thrives. From automating tedious tasks to optimizing content for maximum reach, this course covers everything. If you want to stay ahead of the curve, click the link in the description now and start your journey to YouTube success. Before we dive into the lessons on Bill Holdings stock, let's talk about the missed red flags. Oh, and there were plenty. Cracks in growth projections, questionable expense management, and a complete misread of market demand. How did the analysts miss these financial blunders? What were they looking at that blinded them to the obvious warning signs? Stay tuned until the end, because we'll deep dive into the data they somehow overlooked. Welcome to the Incompetence Court, where we put analysts on trial for their colossal failures. Our first defendant, Brent Bracelin of Piper Sandler, who absolutely blew away the incompetence meter with his wildly misguided call on Bill. Brent began his coverage of the stock in late 2020 with a neutral call that segued into an overweight neutral and then an all-out overweight call, which he essentially held as he played chase and cheer with the stock price until the peak in 2021. When he decided to go all in and overbid at 380. Bold move, Brent. But unfortunately for him, he continued to hold this call and chase the stock price down, with his price targets all the way into the trenches as it crashed, and he still holds on to this ridiculous position to this day. That is crazy. An 84% drop in the stock price, and this wacko is still telling people to buy it hand over fist. On top of that, playing such an ardent game of chase with the price. If you're so confident, you should have just kept your price target at 380 like it was at the peak. Brent Bracelin's bullish call on Bill was built on shaky ground, and what he chose to cite as strengths only made his misstep more glaring. He was enamored with the company's revenue growth and recurring subscription model, often citing the surge in customer adoption as a major reason to stay optimistic. But Brent completely overlooked the skyrocketing operating costs that were eating into any potential profits. He also repeatedly pointed to Bill's leadership in automating back-office financial operations, claiming it would give them a first-mover advantage. What he missed was that competitors were catching up fast, and the market wasn't as impenetrable as he believed. Even when Bill's user growth began to slow, Brent doubled down, citing the long runway for growth, failing to recognize that the runway was actually shortening. As the stock price continued to tank, he clung to these same narratives, pushing price targets that were increasingly disconnected from reality. Guilty as charged and sentenced to a life of unpaid manual number crunching, Scott Berg of Needham is being charged with financial massacre of his clients. Scott began his coverage in January of 2020 with a series of buy calls that essentially chased the stock price all the way up to its peak in the bull run, which was where things really got ugly for Scott. Right before the peak in November 2021, Scott decided to go all in with an overpriced buy call at 370. Unfortunately, however, the stock began its plummet right after he decided to do this. Scott backed down slightly on this call with a price-chasing buy call of 200 in May of 2022, but most of the damage had been done already as the stock had been getting hammered for the previous 6-month period, leaving investors who had listened to Scott in a state of financial catastrophe. He then held on for well over a year to this now ridiculously overpriced buy call, only to price chase again by lowering it to another overpriced buy call, which he still holds to this day. Absolutely mind-boggling. Scott, much like his counterpart Brent, completely misread the signals when it came to Bill Holdings. Disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. One of the key signs Scott ignored was the company's deteriorating fundamentals. Despite Bill's impressive revenue growth, he failed to recognize the growing chasm between their top-line numbers and the increasingly worrisome operating losses. The company's overhead was ballooning, largely due to mounting operating expenses and aggressive expansion tactics that were not translating into sustained profitability. Scott seemed enamored with Bill's surface-level growth, praising its recurring revenue streams and customer acquisition strategy, but he overlooked the fact that this growth came at a high cost, one that was unsustainable in the long run. Throughout his bullish calls, Scott was fixated on the potential for Bill to continue dominating the back-office automation space, continually touting its leadership in automating financial workflows as a unique advantage. He cited the adoption of Bill's platform by small and mid-sized businesses as proof of its scalability and long-term growth prospects. But Scott missed the clear warning signs that the competitive landscape was shifting rapidly. Established players and new entrants alike were catching up, offering similar solutions at competitive prices. The moat that Scott believed Bill had was shrinking, and he neglected to factor this into his valuation models. Moreover, as the macroeconomic environment began to shift, with interest rates rising and a broader pullback in tech stocks underway, Scott's unwavering optimism about Bill's stock price defied logic. He clung to bullish price targets that were disconnected from Bill's ability to maintain its high growth trajectory in a tighter economic climate. As the stock started to slide, Scott ignored key red flags like declining customer retention rates and signs that Bill's user base was maturing. This maturity meant slower growth in new customers, a reality Scott dismissed by doubling down on his belief that Bill had a long runway for growth. Guilty as charged and sentenced to revisit the basics of financial analysis, this time without the use of rose-colored glasses. Samad Samana of Jefferies is being charged with issuing stock calls that were so misguided that had investors simply taken the inverse of his advice, they would have seen significant returns. Samad began his coverage of Bill back in January of 2020 with a series of neutral calls that chased the stock price. He held this neutral position until August of 2021, when he segued into a buy call. Unfortunately, this buy call was made right before the peak, and he held it all the way into the trenches, and still to this day. Had an investor simply went all in when Samad was smoking the wacky tabaki and claiming he didn't know what to do, and sold out when he said buy, then would have made a ridiculously handsome return. Samad ignored several critical signs in his analysis of Bill. He overlooked the soaring valuation of the stock, which was trading at an unrealistic valuation, failing to recognize that it was significantly overvalued as insiders began to cash out. Although the surface-level revenue growth seemed appealing, he completely ignored the losses and escalating costs, which indicated that Bill's rapid expansion was far more expensive than it appeared. While it is true that in 2021, the average net profit margin was negative 45%, marking a substantial improvement over 2020, the overall trend still indicated increasing losses over the years, with profit margins showing consistent negative values. Samad ignored these facts, which should have tempered his bullish outlook. Samad Samana is guilty as charged. His failure to recognize the obvious warning signs while riding the stock into a nosedive reflects a concerning lack of judgment and diligence. As a consequence, he faces a lifetime ban from issuing stock recommendations and a mandatory sentence of 10 years as an unpaid intern, tasked with fact-checking real analysts' work. Furthermore, all his future stock picks must receive pre-approval from retail investors on Reddit to ensure public safety. Joseph Vafi of Canaccord began his coverage of Bill a little later than the rest, but he wasted no time. Joseph immediately grabbed his pom-poms and began to play chase and cheer with the stock. And then, similarly to our friend Samad, he went all in with an overpriced buy right as the stock began to peak. And just as incompetently as our friend Samad, he held this call into the trenches, and to this very day, guilty as charged. Will Nance of Goldman Sachs is being charged with wishful thinking instead of analysis and gross incompetence. He began his coverage of Bill Holdings in January of 2022, right after the crash began. He started with a buy call at 296, which was significantly overpriced by about 17% at the time. Then in April, he doubled down by raising his target to 340 as the stock continued to get hammered. Wishful thinking, Will, but unfortunately these guys aren't paid to make wishes. They are paid to make sound analysis based off of reality. To add insult to injury, he held this well into the trenches, where he began to play chase and cheer, and he is currently segueing into neutral with his last neutral buy in August of 2024. No further analysis, Your Honor. I rest my case. Guilty as charged on all counts.